Hi everyone, this is John Lewis with Smart Options Income. Today I want to talk to you about something that a lot of people don't like to talk about, and that's losing trades. I don't mind talking about losing trades because I know they're part and parcel of any trading strategy, and I certainly encounter losses in my Smart Options Income service just like everybody encounters losses in their everyday trading. And dealing with losses and knowing how to cope with losses, I think, is one of the major ingredients into being profitable in the long run. So today I want to talk about closing a credit spread early for a loss and how that can often be a winning strategy. Now, when I talk to people about credit spreads in various seminars and webinars, things like that, one of the biggest complaints that I hear, and I hear it all the time, is that one loss wipes out several of my winners. And certainly that is a factor in trading credit spreads. When I trade credit spreads, I'm usually looking for average win sizes of around 20% or so. And if I come up with a loss that's minus 100%, obviously that's going to wipe out 5 of my winners. And that's clearly something that I want to avoid. So the solution for my trading is that I like to limit my loss to no more than 2 times the original credit. So the most winners that my loss is going to wipe out is 2 rather than that 5 or maybe 6, something like that. So we want to avoid those really catastrophic situations and the thing that turns a lot of people off of credit spreads. So I want to go to a trade that we recently did on Apple to illustrate this point. This was back on November 8th when Apple was trading around 208. We decided to put on a bullish credit spread using puts, so a put credit spread. And we ended up selling the December 14th expiration 195, 192.5 put spread, and we got 42 cents for that. So we sold the 195, we bought the 192.5 puts for a 42 cent credit. And this trade had about 5 weeks to expiration, 36 days. And we were looking at a 20% maximum return. And we calculate that by taking the credit, which is 42 cents, and dividing it by the margin that's required. And the margin is simply the width of the spread, in this case 2.5 points, minus the credit that we receive. So 2.5 minus the 42 cents gives you that 208. And dividing 42 by that 208 gives you that 20% max return. Now, the problem was, as you probably know, if you know anything about Apple, was this was a really, really bad time to be bullish on Apple. In fact, the stock, while we were in this trade, the stock was in the midst of its monster slide from the beginning of October to the beginning of December that covered around 30% in just that 2-month period. So not a good time to be on Apple, and we pretty much got taken out of this trade pretty quickly. So just 6 days later, on November 14th, Apple had already lost 8%, and it was trading down around the 191 level, and we ended up buying back the spread for $1.20. Now remember, we got in for 42, and we had to buy it back for $1.20, and that represented a 78-cent loss, and that was a little less than 2 times that 42-cent credit. And that overall resulted in a 37.5% loss on margin on a trade that lasted just 6 days. So a pretty brutal result. However, had we held to expiration, again, as I said, Apple was in the midst of that monster decline, that 30% decline. Had we held to expiration on December 14th, Apple closed on December 14th at 165.48. And that represented another drop of 13.5% after we got out of the trade. So had we held on, Apple, all the way to December 14th, Apple would have declined another 13.5% at expiration. Obviously, at that point, both legs of the spread would have been deep in the money, and we would have experienced the maximum loss on that trade, which is the margin that we put up, or that $2.08. Obviously, that's a 100% loss on margin. So instead of losing that 78 cents when we closed early, we actually lost $2.08. And in all reality, we probably would have been assigned the stock, which would mean additional fees and things like that. And that's something that people really want to avoid. They don't like being assigned on when they sell options that are deep in the money. Now, an alternative solution to this, although the trade was a loss, I still consider it a good result because we avoided a much bigger loss. We avoided that wipeout that would have really covered several of our winners. Now, an alternative solution to this, rather than closing early, is to sell spreads in which the credit is equal to 1/3 the width of the spread. And when you do that, the most you can lose is that 2 times the credit that you receive up front. So let's say you have a 3-point wide spread and you sell it for $1. Well, the most that you can lose is $2, right? Because the most that spread will be worth, if everything goes south on you and doesn't work out and both options are in the money at expiration, the most that spread will be worth is $3, but you got the dollar up front, so your net loss is $2, which is 2 times the credit that you receive. So one way to get around this closing early is to get a seller spread in which the credit is equal to 1/3 the width of the spread. Now, in order to do that, though, you're going to have to be a lot closer to the money with your sold option. Usually you're around a 40 delta level or so, and I usually don't like to do that as much because it lowers my overall win rate. I like to keep that win rate up around that 70, 75, 80% range because I want to have that steady stream of income. So to me, selling options with that are further out of the money and managing that 2x level is the preferred strategy to keep that win rate high. So just want to illustrate what a losing trade for us looks like. Clearly, I didn't like it, but honestly, that trade didn't have a chance from the get-go. If you look back at it and look at the chart, we pretty much got destroyed almost right out of the gate. But that's, again, losses are what happens. Those things happen. It's going to happen again. And when it happens again, we're going to close early again because we want to limit that loss. We want to avoid that 100% loss. So just a way that we deal with losing, and that's how we can keep our overall result profitable by limiting those losses. So once again, I'm John Lewis for Smart Options Income. Thanks so much for tuning in, and we'll talk to you next time.